Good morning and welcome to Monday Morning Market Wrap. I'm Greg McKenna and it's Monday, October 12, 2015. It's going to be a big week this week. Got plenty of data in the States, lots of data here at home, and of course we've got earnings season. But before we get to that and the outlook for some markets, including the ASX 200 and oil, it's been a quieter night on Friday night in the US. Only some small rallies. S&P was up 0.07. The Nasdaq was up 0.4 and the Dow was up 0.2. It was a much better night in Europe. The DAX was up 1%. That brought to a close a pretty solid week of gains. The Dow and the S&P were up over 3%. The FTSE was up something like 4.6%, and the DAX was up 5.6, 5.7% over the course of the week. It's all part of this rebound that we've seen in global markets from the acute bearishness of what we saw in August and September. And while it's easy to say for many, I didn't expect that kind of stuff, I think you've just got to look at the price action. We saw an acute period of weakness in August. We saw a snapback. We saw what I would consider just to be a natural pullback from the snapback. And then we spent almost a whole month retesting the lows. So whether you're a chartist or not, but think about that psychologically. We're testing the lows, we're testing the lows, we're testing the lows, we're testing the lows, we're testing the lows. And every time the bears tried to hammer the price lower, the buyers just kept coming back. The price action just kept coming back. Now, what does that tell you? Forget about the charts if you don't want to be a technician. It tells you that somebody or something or a whole bunch of people were down there buying. So the natural impact of that is once people start to see a low, once people start to see a market form a base, they're happy to buy. Once it starts to rally away from that price, then they start to chase it. And that's why we've seen some of these big moves over the last couple of weeks. We're seeing them in emerging markets. And Ray Atchell from National Australia Bank, the co-head of currency strategy, wrote this morning that currencies were more lively than equities or bonds, further strong gains in some of the most beaten up emerging market currencies of the past few months. The Indonesian rupiah added another 3.37 to be 9% higher on the week. And the Malaysian ringgit was up 2.6%. It was up 6.9% on the week. That's a really big move. Just a natural reaction to markets stopped falling. From an Aussie dollar point of view, the liveliness means that we opened the week, we're currently at 73.22. That's the first time we've opened above 73 cents since around mid-August. Now that's coincidental with the Commodity Research Bureau index of commodity prices also being at 2 months highs. It's at 202.7. It's actually 203.2 according to Reuters this morning. So, you're seeing that commodity prices are supporting the Aussie dollar. That won't stop Bill Evans, though. Have a look at the piece I've written at Business Insider today. Billy Boy's got his bear suit on, and he's got it on firmly. Forget about all this good news. He's got three key factors that's going to drive the Aussie dollar down to 66 cents over the next 6 months or so. One of them is the Fed. He says the market's underpricing the chances of a Fed hike. He says that if energy prices stabilize and the US dollar stops falling, that you're going to see inflation back at 1.6% pretty quickly, and then the whole narrative around the Fed tightening really starts to change. He also says that it will be natural for employment growth to slow down once we get the consolidation phase after the recovery phase. Both really good points. So one, he reckons that the Fed is still going to tighten. He also says that commodity prices, and particularly iron ore, are going to start falling again. And then he says Australia's got a chronic current account problem, and that's going to be an issue for us. So these are things. Anyway, have a look for a full take. So, but as it stands today, the Aussie's at 73.20 and looking okay. I still think that 74 figure 30 region is my target, but we're now in the zone where I'd be starting to lighten the load on some of my longs. That's also the case for oil. I'll just bring you up a chart of oil. Oil hasn't been above its 200-day moving average for well over a year, since July 2014. And as you can see last night, this is in MT4 terms, the price of crude Here's our nice big sell-off. I'll get rid of these Fibos because the Fibos aren't really conveying anything there. Had this nice massive sell-off, you know, down, 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 down. Snap back, consolidation. Look at that nice bottom takeoff. Now we've hit the 200-day moving average. That's really important because for a lot of traders, the 200-day moving average is their delineation between the bull and the bear case. So gets through there, you could really see it run. But for the moment, it looks like it could be slightly overdone, and I'm expecting a move back into the sort of the low 48, maybe high 47 region over a couple of days, and we'll see how it goes there. While I've got the chart open, let's also have a look at the ASX 200. You can see here that we've got back up towards our range top where that line is there. That's natural resistance for the ASX, but it does look like it could probably go higher. One thing to note is that the US earnings season really takes off this week. We had our COA last Friday morning, and that was the first, but it really kicks off. And Brian Belsky, who's the Bank of Montreal's capital markets, BMO's capital markets chief investment strategist, he's the dude that back in late September said it's time to go out and buy stocks. He was a day or two early, but then he doubled down and said buy the following week after we'd ended that Friday really in a bit of a pickle. Well, he said that he thinks earnings season is going to be good. He said, we firmly believe near-term earnings growth will wind up being much better than expected when all is said and done. In fact, the more comprehensive look at the earnings picture and trends in corporate guidance and earnings quality likely set the stage for another surprisingly resilient reporting period in our view. That's his view, not mine. So obviously he's a bit of a bull. And if that's the case, then of course we get a rally in the S&P 500, and we'll get a rally in the Aussie market as well. If I turn back to other markets, sterling came in for a bit of a thumping. Well, not really a thumping, but a relative thumping. You know, you've got euro up here at 113.58, and sterling down 153.17. That's really slammed Aussie. Sterling Aussie. It's funny, I always think in Aussie sterling terms, always have, but most people trade it in sterling Aussie terms, so I get confused sometimes. But anyway, it's down at 208. 208.50 was the target that I set in over the past week or so when I've been talking about my trade in sterling Aussie on my chart of the day, that sort of thing. And so from that point of view, that target is now been satisfied. Looking further, you know, we could see a consolidation here, particularly as the Aussie gets to 74-ish cents. But overall, I'm thinking that potentially sterling Aussie can get back down towards 2. So maybe 201, 202, 203, something like that. So I'm a bit of a bear on that one. Getting back to the Fed, I think I mentioned that, or I may not have, that Stan Fisher, who's the Fed vice chair, he was at an IMF conference over the weekend, and he said that he thinks that even with all the headwinds, the Fed is still on track to tighten rates. So that's something to keep an eye on and how markets react to that. And there's a good piece on Business Insider today. Willem Bitter, who is the Citibank chief economist, he's got a piece saying that the globe is going to go into recession, and that he's made that big call. So have a read of that. Overall, however, you know, if you look at oil, it bounced strongly last week. You know, we're in this ebullient phase of the crash, rebound, strength, and now we're looking for resistance. So I'm not necessarily bullish per se, but except for oil, I haven't actually seen where the resistance is. I can see where the resistance might be in the Aussie and other markets, but we'll have to see. On the data front today, it's a fairly quiet week start to what's going to be a massive week. Japan, Spain, and Canada are all out for holidays. But we've got speeches from Fed's Lockhart and Evans, and then, of course, the Bank of Canada's Stephen Pollers is speaking tonight. One thing I would do is recommend that you have a look at it's under my name, Greg McKenna. You'll see it, and it's a huge data week. We've got the NAB business survey tomorrow. I'm going to be watching really closely to see how conditions are and whether or not confidence has started to rise with conditions. There's a great chart in my Oz diary there of the relationship between that and final demand. So that being said, That's what we're looking for in the Australian economy. We're looking for a pickup in consumer confidence, a pickup in business confidence, and then a pickup in economic growth. That's going to help with the economic transition. Of course, that transition is being helped by the Aussie. But here at 72 or 73 or 74 cents, it doesn't hurt us. 66 cents, 68 cents might help, might pop up inflation a little bit, and 76 or 77 cents wouldn't kill us. But we're in the zone where the Aussie dollar is really starting to do some good work. So that's worth noting. Wednesday we get consumer sentiment. Thursday is employment. The market's looking for around sort of a 7,000 increase after last month, 17.4 thousand. At some point, we've been rising so strongly. At some point, I'm expecting a pullback in employment. It's a volatile number, but I don't trade employment. I certainly don't punt employment, if that makes any sense. I don't go in with a position long or short thinking that the number's going to be bigger or smaller because it's too volatile. I haven't done that for the best part of 25 years. Trade the reaction or have a position going into it that you've already set with your stops and all that sort of stuff, but I tend not to. One of the things that Bill Evans, that is, about consumer sentiment Wednesday is that it should be okay because it was in the field last week, and it's even though it's likely to have been affected by financial market turmoil, it's going to improve. Got Chinese trade data this week, tomorrow at 1 o'clock. That's going to be huge. But anyway, that's enough for me today. So the levels to watch. Watch the 200-day moving average in oil. Oil's been a good bellwether. Watch Dollar Sing. I'm watching Dollar Sing as a really good bellwether for what's going on in markets more broadly. It's kind of like a developed market, emerging market, if that makes any sense. It's tied to Asia. It's tied to global trade. And when I look at Dollar Sing, it's back down towards the lows we saw in the middle of September. So I'm starting to think maybe that might bottom out. So I guess I'm just getting a bit more, not risk averse, but I'm bringing stoppies up. I'm tightening things. I've already taken 50% of my Aussie position off too early. The sterling Aussie position is now closed. Oil is now closed, looking for a move lower or a pullback. But have a great day's trade, and then we really kick off in trade tomorrow. So have a great day. That's it. I'm Greg McKenna. You can catch me on Twitter. You can catch me at Business Insider. You can catch me at my own website, gregmckenna.com.au. Bye for now.